Yo, good afternoon, the viewers of the Chico Army and any new potential recruits. My name is Tyler, aka Chico, and welcome to the official Crypto and a Cold One. Today's featured brewski is Peroni, aka Peronis. It's from Italy, Italia, and it's a light beer. I've had it before, so I think I'm gonna like it. Yes, sir, I do. It's empty because we actually messed up a few times, so I'm almost gonna have this one done by the beginning. So, you guys, let's talk about something that has been bothering me lately, the Bitcoin ETF. Now, everyone is getting their panties in a bundle over it and really want it to pass, but why? Questions that go through my own head is, do we really need an ETF for Bitcoin to succeed? Why wrap a new financial instrument in old financial tools? Will the ETF be good in the long term for the health of Bitcoin? And if not, what type of coin could take its place? Well, to answer those questions, we need to understand what an ETF is and what happened to other industry sectors with rampant investment in ETFs. An ETF stands for Exchange Traded Fund. They are a collection or basket of tens, hundreds, or sometimes thousands of differing stocks and bonds, or a combination of the two in a single fund. ETFs are allowed to be traded on major stock exchanges, like Nasdaq or the New York Stock Exchange. They are supposed to make convenience for investors by diversifying your risk. If one stock is performing badly, another one can take off, balancing out your losses. They also require less work because instead of you picking your own portfolio, you leave the selection up to a professional fund manager, which might sound good, but is it really? ETFs make up significant percentages of the working class's retirement funds, especially the baby boomers and most of our parents who have been termed Generation X. Now, most of the money within cryptocurrency is coming from millennials. Yes, there is some from both of the two before mentioned generations, but the majority is coming from the 20 to 35 age range. It's pretty amazing that we have gotten this far with the majority of money coming from just this generation. So let's look at what ETFs have done for other industries in more recent times, since banks have been given absolute control of who, what, and where 401k money is going. The year is 2003, and the first gold ETF is launched in Australia. And then in 2004, the US follows suit and launches their own. Now, let's take a little peek-see at the gold price chart per ounce for the past 50 years since the 1970s. Gold prices did grow organically from the 70s up until 2003. Then the largest pump and dump happened for the next 8 years, compounded by the 2008 financial crisis, which we will get into in a bit. And then in 2012, the crash started, and down we went. Now, who do you think were the first people being able to invest in these ETFs? Banks and the elite. They were able to get their sticky hands involved with the financial instrument so much earlier than a person with a 401k account. As we can see from this chart, central banks' holdings of gold started a positive trend in 2005 with an extremely sharp increase just after. And right before the dump of the price of gold in 2012, the banks sold off in 2009. Did they see something we didn't? Of course they did. Now, looking at the chart of their holdings of ETF assets for gold from 2003 to today, a very similar chart, a pump and then a dump, around 2012, which still hasn't recovered. Going back to 401ks, people weren't given the choice of investing in this asset as part of their portfolio. The stock brokerage firms who are in cahoots with the central banks were investing for the regular people, and a majority of the public's money came in from 2007 to 2012. And even though there isn't concrete proof that the banks and elites were the ones who dumped at the top, while the normal people were the ones who suffered the majority of those losses. Now, looking back at the price chart of gold from the 1970s to current times, could the price have grown organically and still reach the levels we see today? Might not be as high, but it wouldn't be much lower. The ETFs were a coordinated pump and dump put on by the elite to line their pockets even more. Basically, they were legalizing theft from 401ks, and this theft wasn't only limited to gold assets. Now, what about the tech bubble, which started in 1995 and subsequently crashed in 2001? The growth of the internet was a beautiful thing. Communication was opened up to the world, and data could be transferred. But again, the central banks and the elite saw this group of assets and knew they could line their own pockets. Guess when the first ETF was launched? 19 motherfucking 90 in Canada. What a coincidence. And the first one in the US, 1993. This was the SPDR fund that tracks S&P 500 stock index and is still the largest ETF on the market, making up 16% of the entire ETF market. Let's take a look-see at the chart of SPDR. 1993 it begins. Slowly but surely it starts to pump like a madman beginning in 1995 until the crash of the Dotcom stocks in 2001. And let me tell you, see y'all later those gains from 401k accounts. Here's the thing, people, guess who got in again first? Banksters and the elite. Actually, regular people weren't even allowed to invest in ETFs in the beginning, only institutional investors. Remind you of the ICOs in the US right now? Now, when people did have the chance to finally invest their 401k money, they were told tech stocks were a safe haven, as technology was the future. So around 1998, money from our mommies and daddies could come in, and they were excited. But the dip that followed went lower than they got in at. And guess who sold at the top? Banks and the elite. Then it happened again from 2003 to 2008, and look, it's going bananas again. Theft from 401ks when people were told by their stockbrokers that this was a safe haven. Collusion at its finest, folks. What about other markets? Real estate. The common consensus for the longest time was this was an asset that would always go up. It was a safe haven for your money, which could always stand the test of time. False. As the 2008 housing crisis revealed to us all what exactly the banks and lenders were doing, coordinating with each other to line their pockets and fuck over the rest of the world. ETFs in real estate are called real estate investment trusts. And looking at historical performance, you can see another pump and dump, which is again going nuts after the 2008 debacle. This is all too clear for me. Now, Chico Army, I have something I need to tell you guys and gals. The Bitcoin ETF is not needed for crypto to survive. Fortunately for all of us, we got in earlier than any of these banks or elite. It'll be great. The reason? Crypto is a person-to-person asset without government regulations. But if the ETF passes, which I believe it will, because banks like Goldman Sachs want to turn it into another ETF pump and dump and line their grimy pockets even more. So you guys, do not let your parents, yourself, or your grandparents put any portion of your 401k into crypto. It's a pump and dump scheme that will hurt in the long term. I mean, how these ETFs will pan out for the world is yet to be officially seen. But if it does crash the Bitcoin price and the informed keep spreading the truth about what's going on, people could actually lose faith in Bitcoin. What type of coin would be able to replace Bitcoin? It would need to be secure, which Bitcoin's proof of work has proved. Number two, it would need the hashing power of Bitcoin, so something that is merge mined with Bitcoin. And it would need to take a fully decentralized view and provide something called Web 3.0, a truly new internet. That is why it's possible, and I'm not saying this is for surely the case, that Elastos could outdo Bitcoin if the cards fall in the right place. Elastos, by this time, will be merge mined with most ASICs, about 10 to 15 years, because why not? It's a bonus token for the miners. This means the security is completely there. Elastos is a Bitcoin sidechain, so it will have the aura of Bitcoin attached to it. Also, Elastos is looking to create a fully decentralized internet republic, and the tech is literally changing the web as we know it. With the distrust of Bitcoin due to it being wrapped in ETFs, a price flip could very well happen. Well, viewers, I hope this episode gave you some enlightenment, and let me know what you think of this all. Cheers, and as always, Chico will see you tomorrow.